First Trades, presented by BSC, Investors Protection Fund.
Welcome back. That is the SGX Nifty, 30 minutes, and of course we're gearing up for a relatively busy local day of trade. It's looking quiet globally as well. Things aren't really shining on in the morning session. Well, one sector that we are now putting focus on is the real estate space. It's had it rough in the last couple of years, but it seems like things are set to improve in 2013, and that's at least the view coming in from Crisil. Mohit, Director Equity Research of Crisil Research, joins in to tell us why he's of that opinion. Morning, Mohit. Thanks for joining in. Mohit, it's been rough for the real estate pack for the last couple of years, but you seem to be of the opinion that the next year could see an improvement for the real estate majors on back of course, improved demand and lower interest costs is what you're betting on. Is that correct?
Absolutely. What we have seen is in the last couple of years, in fact in the last 4 years, there has been a swelling of balance sheet for real estate companies, and the situation seems to be bottoming out over the next 1 to 2 quarters. It has in fact started happening with some of the companies that are fundamentally good in the pack. Essentially there were 3 themes that we think should play out over the next 1 year. Number one is the demand side situation. We believe that the demand side situation should improve as we see an overall improvement in GDP and also with the interest rate softening that is expected. The second theme that is emerging out is that most of these real estate companies are highly leveraged and their interest outgo is a significant proportion of their total earnings. So at this level we believe that the respite from an interest rate softening would be significantly high for some of these companies. Just to give some perspective, if we analyze 23 companies in the real estate, publicly listed companies in the real estate sector, the balance sheet has swelled or the debt on the balance sheet has swelled from almost like 380 billion rupees to 555 billion rupees between FY08 and the current year. At the same time, their earnings have gone down from an yearly aggregate of around 140 billion rupees to around 40 billion rupees. So an interest rate softening should significantly help them. The third thing which we see is as there is traction in this sector, we could see some bit of monetization of their land assets, which should essentially help them in further deleveraging of balance sheets, at least for the companies that are highly stressed. The swelling of balance sheet that happened over the past 4 years was mostly accompanied by a building up of land bank, which could not be monetized because of various reasons. And we see that this phenomena, as more transactions happen in this sector, as there is a softening or as there is a smoothing for companies in this sector, we expect some more transactions to pick up. So essentially these 3 themes suggest us that this sector should be smoother this year.
So Mohit, let's take this up. On one hand, there is a story of more transactions, so basically just more sales revenue coming in. On the other side, there's a story of deleveraging and making the balance sheet more healthy. What makes you optimistic that we will see more transactions? Because 2012 has been the year of transactions being stuck because developers are not willing to lower their ticket prices. Buyers are waiting, hoping for a slightly better entry point. Do you think that scenario will change? Will it change in major markets like NCR and perhaps in Mumbai?
Let me come to first NCR. In the NCR region, there is a significant amount of supply that is planned over the next 2 years. It's around 870 million square feet, and we expect around 70% of this to be up over the next 2 years. So what we clearly see or what we expect is a demand-driven kind of a benign recovery rather than a price-driven recovery. So we don't expect a significant upside movement or any significant movement in capital values. What we expect is a recovery which is led more by the demand side. Coming to Mumbai, the situation has been slightly grim, primarily a number of issues here. Number one, the supply is relatively small. It is at around 270 million square feet. The second thing is, and we expect around almost the same 70% kind of execution rate in Mumbai as well. The second thing is, over the past 4 years, there has been an annual dip in absorption by around 4%. Now, which suggests there is a latent demand, And for many of the developers, they have not brought down their prices. There has been a kind of a supply crunch in the situation. What we expect this year in 2013 is a demand-led recovery again in Mumbai, as similar to Delhi, not a price or inflationary kind of recovery in capital values.
Mohit, what about markets that have done well? So, I mean, in the last year or so, we've seen markets in Bangalore, Pune, Hyderabad, actually seeing that demand and seeing that transaction that we've seen taking place. Are you telling me that this is going to get even better going into the next year, or would you be betting on the dark horses, cities like a Mumbai, which have not really seen that much pickup in demand?
See, in a city like Mumbai, our expectation is the absorption should grow at around 14% per year over the next 2 years, and that is again driven by demand. You are right, in cities like Pune, in Bangalore, the recovery that has happened has again the phenomena happened through a demand side recovery. We have seen capital values appreciating from the lows of 2008 or early 2009. At the same time, these have not risen significantly high to deter a buyer from buying real estate. And the growth has been, there has been supply as well as there has been recovery through increasing in absorption. And we expect a similar kind of phenomena to play out in Mumbai, though the situation is that there is a latent demand as well as there is a relatively shorter supply. If you compare Mumbai to Delhi, it's almost 1/3 the supply of what we expect in Delhi. So the capital prices are already hardened up to adjust for this kind of a demand supply scenario.
Okay, so Mohit, if you're talking 2013 in terms of the best geographical investment market, which one would that be?
See, if you look at from an investor's point of view, we don't expect a significant increase in any of the markets from a capital value point of view. So just from a very short-term play or a very short-term play, it's very difficult to say whether there will be any market which will give significant upside from a pure investment point of view. At the same time, the malaise that has been in this sector for some time, which has led to a significant kind of decline in transactions. I think that should play out well, and if there is an investor who wants to have a long-term view, I think it would be as per his or her risk appetite and as well as choice. I think capital values are going to remain almost as in they are not going. We don't expect them to harden up significantly. So that's our call.
Mohit, very lastly, top stock buys in the real estate sector for 2013.
See, we actively track 5 real estate companies, 4 of them on the residential side and 1 is Phoenix Mills. On the residential side, we track Ashiana Housing, Parshnath, we track Bhartiya International, and we track Nitesh Estates. We grade companies on fundamentals as well as we ascribe a fair value to them. On fundamentals, our call on Ashiana is 4 on 5 or superior. Fair value is 256 rupees. On Phoenix Mills, our fundamental grade is 3 on 5 or good, and fair value is 245 rupees. On Bhartiya International, our fundamental is 3 on 5 or good, and fair value is 180 rupees. On Nitesh Estates, our fundamental call is moderate, which is 2 on 5, and fair value is 25 rupees. On Parshnath, our fundamental call is 2 on 5 or moderate, and fair value is 54 rupees.
Thanks a ton, Mohit, for joining, and that's the view coming from Crisil Research. They, of course, are of the opinion that things are set to change for the Realty Pack in 2013. Having said that, the BSE Real Estate Index year to date is up about 51%, so it's already been quite hot in the last couple of months, to be fair. We'll take a break, but on the other side,